What's happening, everybody? Welcome to the exam breakdown. We are live. It is Wednesday, February 12th, 2025. Holy moly. February is like flying. January flew by. There's like things are just like in hyperwarp. And so we move and we go. And the point of today is to get us through some loan originator training for the NMLS pre-licensing examination. And this is for my friends that are studying for it all over the United States. So this training is good everywhere, anywhere, anytime as you are studying for this examination. Hopefully the goal is to cut through some of the extraneous information and focus on things that I, as an educator, have been working on for a long, long time. Just looking over my shoulder and making sure everything looks good. We've got some wonderful comments and a lot of students passing their examinations and super psyched. So we appreciate you. Just showing a couple of those clips, and I just want to make sure that you see them. It's pretty cool to see that many comments coming through, and they're positive comments, to boot, which is great. I'm just going to flip this off. All right. So we have got some interesting bits to go over today, and one of our students requested a specific training, and I'm just going to pop that up. Just give me a second, if you will. Just bring that over here. All right, so there we go. All right, I'm going to read this on my phone. It's probably flashing up there for y'all. All right, so at Crowned in Curls 93, excellent handle, by the way, basically said, I love the question about changed circumstances. So we just did a training a few weeks ago live. Check the live videos, and you'll see I went through a question, and it was about changed circumstances. And this is specifically for the loan estimate, and we're going to be going over that today. And the request was, I would love an in-depth video about it. So basically, at Crowned in Curls 93, we put this together. Hope you're listening. If not, we'll make sure we tag you when we post this. Any of y'all that can't be with us live, no big deal. You can always watch the replay. It's going to be posted right away. And the goal of this is to kind of give you a few moments of clarity and discuss a topic, maybe explain potential opportunities of how they might bring questions to you, and hopefully shed some light on particular items that I, as an educator, feel are high probability potentials on exams like this. Now, I do not have a copy of this examination, and I certainly don't want you to think that I do, and I'm teaching to the test, etc. I just want you to understand that I've been doing this for 30 years. I've trained thousands and thousands and thousands of folks quite happily. Love teaching, and what I really like doing is trying to gamify and figuring out, well, what could a question be like? What would be essential? What would be relevant? And just because of years of doing this, not just this discipline, but so many other ones, I can tell you my targeting system is pretty decent when it comes down to it. There are only so many things, and again, with a reasonable probability that I might miss something, but I know for the most part, I usually hit most of the time. So I definitely think that that's what the skill sets are that are going to help you. And I'm going to try to think about things as we're presenting this to hopefully give you that. Now, those of you that have subscribed to our channel, my goodness, thank you, thank you, thank you. Our channel is growing. We couldn't be more happy. Again, it is the mission of this particular channel's content is to help you get through the noise of the stuff that you don't need, focus on the stuff that you do, and make sure you're passing your exam so you can continue on forward. The loan origination business is an excellent business. The business of loaning money is awesome. And if you do it right, you do it intellectually, morally, ethically, and everything else, it is going to serve you well. Now, one note, as I am streaming this today on the 12th, the year 2025, February, we're seeing stuff in the news. You might have heard that the CFPB, my bad. CSBS is something different. It's Conference of State Bank Supervisors, and they're still in force. But the CFPB was basically shut down temporarily at this point, and then there's a lot of confusion. Well, what does that mean? As you know, if you're studying this, that enforcement actions are performed at the federal level through the CFPB. And on the examinations, CFPB is the enforcer. So what's going to happen for those that are a little curious, initially, these exams aren't going to update right away. You're still going to see the Consumer Financial Protection Bureau still be the enforcement division if you are taking this examination in the short span. Inevitably, once the dust settles and things are figured out as to what's happening, then those things will change. So if they remain closed, then what will happen is some different body of enforcement will take over. It could be Office of Comptroller of Currency, Treasury. It could be somebody in that world that is going to also enforce on this level. But licensing is not changing. That's overseen by the states. And the states have a coalition called the Conference of State Bank Supervisors, which has nothing to do with the federal level. It's self-funded, and the NMLS is this machine that's going to continue to operate. So my belief, looking at everything, there's an extremely low probability of a state, let's say, defecting and removing themselves from this whole operation of licensing. They would effectively be cutting themselves off with intelligence and it's subjecting their citizenry to fraud from, let's say, bad operators in other states and stuff like that. If without the data that the enforcers in those particular states have access to because of the nationwide mortgage licensing system and service. So there's an extremely low probability that anything's going to happen with licensing. Y'all still need to take this stuff. Y'all still need to practice and study for your exams. And y'all still, if your license, are going to have to show up to your continuing education. So I'm sorry, education is going to continue. All right. So that's my big thought of the moment. Let's get into changed circumstances. And, let's get into this. So changed circumstances are important. I'm just going to get rid of this comment. Give me a second. And I'm back. Okay. Put my charming face for radio on the bottom here so I can see you all. All right. So changed circumstances. This is looking at an important document called the loan estimate. The loan estimate is an estimation of charges that a consumer will incur if they decide to move forward and do business with a particular lender. That is a loan estimate, and it is given to a borrower up front at the time when application has taken place. So last week we talked about what is an application. This week, we're moving forward a few inches and we're saying, okay, once the loan officer has taken the application, and if you remember, the loan application is also referred to as a 1003. Fannie Mae created that form, the 1003. And what we do from there is within 3 business days of this application, then this document called the loan estimate has to be given to the consumer. Now, it breaks down closing costs and what costs the consumer will incur up through closing of this transaction. So it's giving this good faith estimate. We used to actually call it a good faith estimate. Now they just call it the loan estimate. Now, TRID is the marriage of 2 major laws, the Truth in Lending Act, or Regulation Z as it's implemented by, and the RESPA, Real Estate Settlement Procedures Act, Regulation X. Think signed by the X. If you're trying to remember what Regulation X is, it's RESPA, signing by the X. It's settlement services and deals with settlements of real estate transactions. So we married these 2 laws together, and we came out with 2 documents of disclosures that are of relevance for this exam, the loan estimate and the closing disclosure. Now, this segment is all about the loan estimate as we are talking about changed circumstances. You see, here's the logic. The logic is regulators found before these changes were implemented that banks would change the numbers. Loan officers would change the numbers to kind of suit their needs. And they would pad the good faith estimates, unfortunately. A lot of unethical practices would take place. So, for example, not saying that this is anybody, I'm not trying to blame anybody, but I'm just trying to explain what happens. Let's say, hypothetically, I'm originating a loan and I issued you a good faith estimate. This is predating the loan estimate, right? Let's even say currently. And what happens is let's say the loan officer decides, hey, listen, I just got a referral from a real estate agent and I want to be able to pay them $500 for this. I don't want to pay them out of my pocket though. I want to pay them, why don't I just, stick it on the good faith estimate, disclose it to the consumer, but I can't call it a referral fee because you're prohibited from doing that, right? It's Section 8 from RESPA violations. And so what I do is I say, okay, instead of charging them $500 for processing, let's charge them $900 for processing. Now, I initially I bait you into showing you the cheapest costs, right? Hey, look, not only are my rates the best, but my cost is the lowest. And I just pad my good faith estimate. I just, okay, here you go. It's just a disclosure. And then closer to closing, I would pull the wool over your eyes, or I wouldn't even redisclose to you. I would simply just let it be, raise the numbers, and then at the settlement, you'd be looking at your final settlement statement. You're like, well, wait a minute. I thought you told me it was like $500 and 1 point in origination. This is 2 points in origination, and it's $1,000. What happened? And then the loan officer might say, if it was even questioned, if it was a purchase deal, who's going to question it? You've got a seller waiting in a moving truck trying to get their money, and you've got a buyer and their family in a moving truck trying to move into the house. It's this buyer's remorse scenario. Borrowers got shilled and shilled and shilled through these types of practices. So as regulators were picking up the pieces from the economic crisis, they go, man, we need to fix this. We need to say, when you make a loan estimate, it is a firm estimate and it is to the benefit of the consumer. If you're ever doing it to the detriment, like the prices miraculously go up for some reason and you're not redisclosing for legitimate bona fide changed circumstances, well then you can't do that. And you're going to have to give refunds. You're not allowed to do that anymore. And so in order to change that problem or to fix it, this is what changed circumstances are. All right. Hopefully that gives you some context to understanding, well, what the heck are they as you're reading them? If you're brand new to this business and you've never heard of good faith estimates and the previous things prior to the economic crisis, this stuff is a little weird because you're just not 100% sure why. All right, so hopefully that gave you some understanding. Now, the loan estimate provides the borrower with an upfront breakdown of loan costs. I'm just going to get something to write on here. I'll do it. So we're looking at this section right here. This is the loan estimate. Some fees have zero tolerance, meaning they cannot change. So one of the fees that should never change is what the loan officer promises to charge you to do their services and their costs. You should know what those are. So they have zero tolerance. I'll show you a list. But things like loan origination fees cannot change, again, unless there is a bona fide change circumstance, which we'll go through, that prompt a change in fees. Others have something called limited tolerance, allowing for a 10% cumulative increase. So the regulators found that there are certain charges that they can only increase cumulatively by 10%. And they did that cumulatively because they want to make sure that somebody isn't trying to pad little fees and make windfalls. They want to make sure that everything is legit. So they looked at the aggregate number and they said, cumulatively, if anything changes above 10%, then you're out of compliance. This is being done in bad faith. And then some fees can change at any time if the bank has no control over these fees. So for example, it could be some sort of insurance charges. And like the consumer says, no, I'll get my own insurance. Well, the insurance agent has nothing to do with this closing, and those fees are out of the bank's immediate control. And therefore, I can give you an idea of what insurance costs, but if your insurance company comes back way more expensive, that's really not my problem as a lender. So there are some fees that have nothing to do with the lending process. However, it has something to do with the closing process. And therefore, if you're shopping on your own, then whatever you're shopping for, I have nothing to do with. That's these charges here. Now, lenders must follow the TRID integrated disclosure rule to ensure compliance. And TRID, you want to know for your exam, stands for the TILA-RESPA integrated disclosure rule. All right, let's go to the next slide. What are those fees that are zero tolerance? Fees that cannot, in essence, change unless we have like 4 types of changed circumstances. And we're going to get to those in a minute. These fees cannot increase once disclosed on the loan estimate, or LE. You definitely want to know that. They call it that, except for these valid changed circumstances. Still a little vexing. What are those, dude? And I'm going to tell you in a minute. But the fees that cannot change are your number one, origination fees, period. What the lender quotes is what the lender needs to deliver, period. Discount points, if the borrower selects a rate and the lender locks it. Transfer taxes. And third-party fees if the borrower cannot shop. Example, appraisal fees, credit reporting fees, and flood certification fees, all within the control of the lender. Those also cannot change. And you want to have a running list of these items. Let me just bring that up a little bit and make that a little bit smaller. There you go. All right, so those are fees that cannot change. Again, unless we have a valid changed circumstance. We're going to get there. Then there is the second category of fees, 10% tolerance fees. Limited changes are allowed. And these fees can increase up to 10% cumulatively, but not per item. If the total increase exceeds 10%, then the lender must issue a revised loan estimate and cover any excess. So if they've made a mistake, even clerical errors, examples here would be government recording fees. Third-party fees if the borrower can shop but chooses a lender-approved provider. Example, title services and things like title insurance. And required settlement services selected from a lender's provider list. So if it's a provided list of service providers that are working with the lender, then these fees have a little bit of wiggle room cumulatively, but not much. 10% is not a huge wiggle, okay? Fees are tracked cumulatively, not individually. You want to know this idea for this category. And so you want to remember some of these examples like government recording fees and title services and title insurance. These things can move a little, but not move a lot. Now, service providers that a lender uses that are reputable lenders and reputable service providers are pretty good with their pricing and they're honorable about things. And so it's all good if people are ethical and moral and, the whole nine. But if there is any tomfoolery, that's an old phrase, then, that's what this is for. Tomfoolery. Stupid phrase. Okay. The next thing, these are fees that can change for whatever reason. And these are out of the lender's control. Okay. So they are not subject to a 0 or 10% tolerance rules and may fluctuate due to the borrower's choices and market conditions. So it's like paying market fees or market rate for the fish at a restaurant. We've got prepaid interest. This varies based on the closing date. That's out of the lender's direct control. They can try to do something. They can estimate, but they don't know exactly when it's going to close. Homeowners insurance, if the borrower selects the provider. This is the operative phrase. If the borrower is picking and the lender is not in that list of providers, then no. Escrow deposits for taxes and insurance. Maybe the jurisdiction is about to get retaxed or the taxes are about to increase or whatever. And so the lender can look at the data that they have available, but that's about it. Fees for services the borrower chooses if not on the lender's list. And we're reiterating this stuff because these are fees that can change at any time. These fees, in essence, are beyond the lender's control. And so the idea is to make sure, as you're learning and studying this, to regurgitate this on the exam, is ask yourself, is the lender in control of these or not? Are these providers that the lender is requiring that the borrower uses, or are they required, or is the borrower able to select from a required list, or is this just out of the lender's control? And literally, if you can think about that charge in those terms, then you should be fine. Now, the only one that's a little wonky here is government recording fees. And so the government recording fees, some argue, well, that has nothing to do with the lender and those could change. But the lender and the title company knows what these are, and these are fairly stable. These aren't aggressively moving like gas prices and like the cost of eggs, but these are moving stable. And these numbers are, statutorily set in many jurisdictions. So that's why it's pretty safe. Okay. And that's just a little bit of a fine point there. Now, the big question of this training is, well, what the heck are changed circumstances, D, Mr. Beard? And the answer is here. A revised loan estimate is only allowed under specific conditions, such as, number one, a borrower requested change. I'm going to give you an example of that in a minute, but the loan amount changes or the loan type changes. We go from a 30-year to a 15-year, something like that. Those are borrower requested changes. And then this is what happens for all of these. Borrower requests a change in this example. then the loan officer says, okay, got it. You remember, it's the borrower's money. It's their right to decide the outcome of the type of financing that they want. It is the loan officer's job, inevitably, to provide all of the professional details and the analysis of what these products are, and they do, and everything else. And it's up to the consumer to decide which one they want. Not the loan officer to steer them, of course, no way, into something that the loan officer benefits from versus the consumer, right? So like the idea here is if it's borrower requested, then the loan officer and their department has to simply redisclose the new LE within 3 days of that change and then go from there. If any new information arises during the underwriting process, which could alter or adversely impact the qualification or positively impact qualifications, then like an example here would be lower credit scores. Then that could prompt a changed circumstance. Your credit scores dropped in the middle of underwriting. Therefore, you're no longer qualified for this program, but we can put you into this program. Are you interested? And if the answer is yes, then here we're going to send you the updated disclosure packet, including the loan estimate given to them within 3 days of understanding this new information and how it impacts. Regulatory changes or unforeseen events, even things like natural disasters could potentially, like think about this. This is awful, but you're in loan process and you're in Palisades, and you're about to refinance your home, and you're in this process, and all of a sudden your house burns down, right? So now the lender approves everything, but they have to go back and send somebody out there and say, hey, look, we need to examine this house and reappraise it because the valuation dropped significantly, etc. Right? So like these are changed circumstances. Now, what happens if to the loan officer and the lender if the consequences of incorrect fee disclosures? If fee exceeds tolerance limits, lenders must issue refunds within 60 days. 60 days numbers you definitely want to memorize for this examination would be my guess here. We have to correct the overcharges. We have to ensure compliance with TRID rules to avoid penalties. Now, penalties are regulatory fines, could be at the federal level and the state level. Legal consequences like treble damages, refunding, could lose the right of the mortgage, quite honestly, depending on how egregious or intentional misrepresentation these transactions tend to be. And delay closings, potential lawsuits from borrowers. Hey, because you of all of these issues, we were unable to close. We're getting sued by the seller, blah, blah, blah. It's like all kinds of stuff. MLOs must disclose fees accurately and revise them when needed. So this is a movable goalpost in that regard. We have to make sure things are happening. That's why compliance teams at lenders are so valuable and expensive. So the cost of doing business in a regulatory environment where these things have to be done properly are important and expensive, unfortunately. Summary of the changed circumstances and fee tolerances. We have zero tolerance fees like loan origination charges. These cannot change after the LE is issued. 10% tolerance fees can increase, but the total of all fees cannot exceed 10% from the loan estimate to the closing disclosure. So that cumulative difference, again, I didn't mention it earlier, the cumulative check is coming while we're looking at these two documents, the loan estimate and the closing disclosure. From what we originally disclosed to what the end of the day numbers are, they cannot exceed 10%. Anything above that, the borrower needs to get credited back for. Fees that can change at any time may increase without restriction if valid changed circumstances occur. Lenders must ensure compliance with tolerance rules to avoid violations, refunds, and regulatory penalties. I've seen a lot. I've worked with organizations a lot with compliance. Compliance is one of my thingamajiggies that I'm pretty good at. And I've helped, kind of walk through these examinations and audits, and I've seen some nasty penalties and fines being imposed because of these types of issues. Now, let me just give you a quick breakdown here of this changed circumstances scenario. The first type of change circumstance where borrower requested changes. An example here would be switching from a 30-year to a fixed rate mortgage. All right, gotcha, consumer, no problem. We're switching you out of a 30-year to a 15-year. We need to make sure that we redisclose to you because certain things are going to change, and therefore expect in the mail or in your email in a few moments, within 3 days of this change, your updated loan estimate, okay? Now, an extraordinary event, a natural disaster requiring property reinspection and potentially new insurance. New changed information where, we discovered that there was a judgment on your credit report we didn't know about, this or that. These can change the outcome of the transaction and therefore would prompt redisclosure. And regulatory changes. Example, new state laws requiring additional flood insurance coverage in that state. Additional insurance for fire protection in other states. So these things could change what's going on. Must provide the loan estimate within 3 business days of a changed circumstance. This is important in terms of timing. These are things I would definitely know for exams. No later than 7 business days before consummation. Now, to that 7, I kind of put together a quick understanding of looking at a loan estimate in this regard. Let me just get out of your way. All right. So here, I just kind of whipped up a quick TRID loan estimate timeline. And the idea here is, at application, when we apply for a mortgage loan, within 3 business days of receiving that application, we must deliver or place in the mail the loan estimate, right? So now we just looked at what we can charge, how we can charge it, etc. Now that's within 3 days. Now, 7-day receipt rule. The consumer must receive the initial LE, the initial one, at least 7 business days before consummation. This is important. So there's a rule. It's called the 3-7-3 rule. And it's going to help you learn disclosure timing. And what they're saying is 3 days from application, 7 days. The consumer, so in other words, if you're thinking of it in terms of timing, that consumer needs to be able to digest the information and they have to receive the initial LE at least 7 business days before consummation. Why? A lot of times prior to all of this waiting period, the 7-day kind of waiting period, so the consumer understands what they're getting charged, it's in essence giving the consumer 7 days in addition before they go to the closing table and they're legally obligated on the transaction. Regulators felt that, there could be people that want to do a rush closing. They want to close a refi fast. Maybe the market will allow you to do a transaction. Typically, historically, it's been around 30 days to 45 days from start application to close. But lenders can push things quickly if they need to. They can, especially purchase business. And if that's the case, they still want the consumer to have a little bit of time to understand what the charges are. And that's why the 7-day rule exists. So 7 days. And then if there's a changed circumstance, now the initial LE has to get redisclosed. So we have to revise the new LE. And then that, again, starts to 3 business days from that new changed issue. And this is something I would know for your exam. There is this thing here, the consummation. The last LE, the last updated perfect disclosure, the consumer must receive this at least 4 business days before consummation. Why? Because now the next document is called the closing disclosure, and that has to be given to a consumer 3 days prior to close or consummation. And so the next document, the CD, now kicks in, and that's the final numbers for the closing. So you see how this whole works? Everything is about timing, and some of the critical mass timing is 4 days prior to closing. If we have to redisclose because of a changed circumstance or something, then we need to make sure that that LE is in that consumer's hands 4 days prior to closing, because the next day the title company is going to send over the CD, and the CD is going to have the final numbers. And those two, again, they're going to check for tolerance and for compliance here, because now the CD takes over and now we can no longer issue another loan estimate. So this is about timing. This is about how this game works, and hopefully this is going to be helpful as you are looking to study what is a changed circumstance and how this whole thing works. All right. Man, as I go through this with students every single time, initially for me, it's always like, wow, this stuff was pretty vexing when I first started to look at it. It was confusing at first. Then it makes a lot of sense when you just think about it in terms of helping the consumer. So if you look at it in simplistic terms, we want to make the consumer aware. This transaction has to be clear and transparent. Anything that changes along the way, we want to know about it as soon as humanly possible. So 3 days from these changes, 3 days from application, absolutely, I'm sure if I were a bettor, it would be on the exam. You want to know what zero tolerance fees are? You want to know what limited tolerance fees are? 10% cumulative from the LE to the CD, right? And then things that can change at any time, right? Out of the lender's control. And you want to understand what an example of a changed circumstance would be, what an example of non-changed circumstances, right? So like the lender just did an audit of their firm and they found out that they're losing money, they need to raise their application fees. That's not a legitimate change circumstance. The consumer that's in that pipeline that was disclosed those lower processing fees, still you have to honor those lower processing fees. Period. It is not acceptable to redisclose and say, "Oh, our fees changed." That used to happen. It doesn't happen anymore. Can't do that. And you'll be held to those standards on exams. Look out for them. All right. Remember my little bit in the beginning with the CFPB, kind of understanding what's been happening in the news. I'm sure you're hearing all about all kinds of stuff. And this is specific to the mortgage industry. Dodd-Frank Wall Street Reform Act created the CFPB, and it was the chief singular enforcement authority for our consumer protection laws in the mortgage sector. The examination will not change for a length of time until things catch up. Inevitably, the CFPB remains closed. Then they will figure out who the regulators are, and then we will disseminate that information for you students that are taking this examination a little while away. Some of you might be waiting for that 6-month period after you failed a third consecutive time. And if you are, then keep checking back with us. As we find out from the regulatory bodies, and we will let y'all know what's going on. All right. That is our exam breakdown for today, February 12th, 2025. I hope that you guys found this useful. I hope spending this time with me today will yield you much success. Good luck with your studies and good luck on your tests. Hey, have the comments coming in. Tell us what you want us to teach you. Please, please. We listen to these comments and we try to craft things to help you get through. Please check out our study videos. They are doing well. They are doing right by our student body. Folks are passing. Remember, this stuff is good anywhere, any place, anytime. Thank you for your time. It was a pleasure to spend it with you. I will see you every Monday and Wednesday live. On Mondays, we do real estate professionals, brokers, and salespersons. And on Wednesdays, we do the NMLS exam prep for y'all. Hope you enjoy it. Stay safe, stay well. I'll see you in the next one.